Welcome to CFTC Talks. I'm your host, Andy Bush. Hey, you can subscribe to the podcast by going to iTunes and searching for CFTC Talks, or you can listen to the podcast just by going on our website, cftc.gov, and click on the podcast button. As always, there's a disclaimer at the end of the show that's important for you to hear. This week, we jump back into the world of virtual currencies. Why? We had a recent announcement about two Chicago exchanges launching Bitcoin futures. And after extensive discussions with the CFTC in recent weeks, the two exchanges made significant changes to their proposals at the CFTC's request. The CME Group, Inc. and CBOE Global Markets, Inc. both plan to bring Bitcoin product to the market soon, and both use the self-certification process to accomplish this. Now, what does this all mean for market users and their funds and consumers and the public? Well, that's what we're going to get to today on the show, and I'm pretty excited about it. So we thought it would be a good idea to kind of change this up a little bit and circle up the CFTC team working on these issues and have a roundtable discussion about a wide range of topics, from the self-cert process to the structure of the Bitcoin market to what it means going forward. So we're going to bring on four guests today. So joining me on the show are, number one, LabCFTC Director Daniel Gorfine, Division of Market Oversight Director Amir Zaidi, Division of Clearing and Risk Director Brian Bussey, and Division of Swap Dealer and Intermediate Oversight Director Matt Kulkin. Gentlemen, welcome to CFTC Talks. I can hear you breathing, guys. You can say hello. It's okay.
Hey, Andy. Hi, Andy.
Hey, Andy. Hey, just before we get into the questions, for our audience, just a bit of preemptive apology. There are going to be a lot of acronyms used today on the show, and the good news is that to follow along a little more easily, you can go to our website, cftc.gov, and hover over the About CFTC button, and then click on the CFTC organization to kind of read up on these different divisions and what they do, and it'll help quite a bit. There's also a glossary available at the bottom of the cftc.gov. Trust me, I use this all the time. Now, let's just go around the table really quickly and tell our audience what your division does for the CFTC, and we'll go with Daniel, Amir, Brian, and Matt. So, Daniel, you're up first. What do you guys do?
Great. Thanks, Andy. Well, so I'm Director of LabCFTC, the Commission's FinTech Innovation Initiative launched earlier this year. So the Chairman of the CFTC saw the need for this effort given our rapidly changing and increasingly digital markets. Our efforts are ultimately focused on facilitating market-enhancing innovation, ensuring we have the tools and understanding to keep pace with our markets, and proactively identifying emerging regulatory opportunities, challenges, and risks. Ultimately, we want to be sure we are skating to where the puck is going and not reacting to inevitable change.
Oh, that's great. Hey, Amir, you're up next. What do you guys do?
So, Andy, the mission of the Division of Market Oversight, or DMO as we call it, is to foster open, transparent, fair, competitive, and secure markets through clear rules and effective oversight of the derivatives markets and market participants. DMO also seeks to be the world's foremost authority on the rapidly evolving derivative markets. So what this means in practice is that DMO reviews new applications for designated contract markets, swap execution facilities, swap data repositories, and foreign boards of trade, and examines existing trading platforms and swap data repositories to ensure their compliance with the applicable core principles and other regulatory requirements, including system safeguards. We also evaluate new platform-traded products to ensure that they are not susceptible to manipulation, and review entity rules to ensure compliance with the Commodity Exchange Act and Commission regulations. DMO also conducts high-value added analysis using internal and external data to inform sound policymaking at the Commission and promote efficient and vibrant markets. And if that wasn't enough, DMO also drafts and implements regulations and other regulatory work product to enhance derivative market structure and provide guidance to the Commission and registrants regarding these regulations.
That's, ladies and gentlemen, that's why Amir works weekends, just in case you're wondering. There's a lot there. Brian, I'm sure you work weekends too. What do you guys do?
But a much shorter explanation. So the Division of Clearing and Risk is responsible for overseeing the clearinghouses or derivatives clearing organizations that clear futures and swaps. In this case, it's the Bitcoin futures. A DCO, for those of you who don't know, is the central counterparty, or CCP, between each side of a Bitcoin futures contract. Clearing a futures contract means that the two sides of a trade do not have to evaluate each other's creditworthiness each time they enter into a transaction. That's the job of a DCO, which becomes the counterparty to the two sides of a trade. Clearing is therefore about risk management, and our core job in DCR is to oversee that risk management by clearinghouses.
Fantastic. Okay, Matt, you're up.
Hey, thanks, Andy. And I'm sure your listeners love these acronyms. So I work in the division of Swap Dealer and Intermediary Oversight. We call ourselves DSIO. We conduct oversight over a few different types of market participants. So we regulate registered swap dealers, but for purposes of today's conversation, we oversee a critical set of futures market actors besides the exchanges and the clearinghouses that Amir and Brian just discussed. So that includes a futures commission merchant, which is kind of like a broker or a guarantor that facilitates market participants who want to trade futures contracts. We also look at introducing brokers that facilitate market activity, or funds that are called commodity pools, and commodity trading advisors who advise on trading in commodity positions. We also work closely with an organization called the National Futures Association. It's a self-regulatory organization that really is focused to make sure customer protection measures are in place and are enforced. DSIO is about 75 staff, mostly lawyers and auditors who are examiners, and we're in D.C., Chicago, New York, and Kansas City.
Okay, great. Hey, guys, thanks for that overview. I really appreciate it. Given all that, Daniel, let me start with you. I think we could talk for hours about Bitcoin, and I think you and I have over the last couple of months, but briefly give us some context on Bitcoin and virtual currencies, as the price of Bitcoin has soared 10 times this year alone.
Yeah, sure, Andy. So virtual currencies, and most notably Bitcoin, emerged as a new financial technology innovation only in 2008. The IRS gives us a pretty good working definition of virtual currency. At its most basic level, it is a digital representation of value that functions as a medium of exchange, a unit of account, and or a store of value. When Bitcoin was launched by a person or group that used the name Satoshi Nakamoto, it was noted in the original white paper that what is needed is an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties to transact directly with each other without the need for a trusted third party. Bitcoin is accordingly pseudonymous or partially anonymous in that an individual is identified by an alphanumeric public key or address. It relies on cryptography for security based on public and private keys and complex mathematical algorithms. And Bitcoin runs on a decentralized peer-to-peer network of computers, which includes miners that do work to validate and log transactions on a permanent public distributed ledger that's visible to the entire network. Ultimately, this network enables the transfer of ownership without the need for a trusted central party, and effectively solves the double spend problem that had always required a central party to verify that someone has the funds they are attempting to spend and to be sure that they don't use those same funds twice. Now, in terms of use cases, the primary vision for Bitcoin, as I noted above, is for payments, or allowing an individual or an entity to purchase goods or services using Bitcoin. I will note that it's unclear at this stage how widespread adoption has been of Bitcoin as a payment vehicle. Bitcoin can also be used to transfer money, including with respect to international remittances, and that can potentially be done at lower cost than traditional alternatives. Some folks view Bitcoin as a new store of value. In some ways, you can think of it as similar to precious metals in that capacity. And finally, some view Bitcoin as a new trading instrument, which can result in capital gains or losses and may involve significant speculative and volatility risk, especially given the nascent stage of the technology.
Yeah, and I think that's where we're seeing so much in the media and the press about it, and obviously it's almost every day it's the front page story. By the way, I think for everybody who's listening out there, I think it'd be a great idea for everyone to read the LabCFTC's virtual currency primer. It's been a big help for me, but I think that that's something that will give you additional context besides Dan's 2-minute overview of a very complex subject. Amir,
I tried to squeeze it in there, Andy.
I know. Well done. I don't think I've heard anybody explain it that concisely, so my hat's off to you. Amir, I want to bring you into this conversation because, as you mentioned, one of the many things that your division does is review new product applications for designated contract markets, or DCMs, like the CME and the CFE. Walk us through this process by which a DCM can list a new contract or a product on its exchange.
Sure. So prior to listing new contracts, the Commodity Exchange Act provides DCMs with the option to either submit a written self-certification to the CFTC or voluntarily submit the contract for commission approval. Now, when a DCM self-certifies a new contract, it must determine that the offering complies with the CEA and commission regulations, including that the new contract is not readily susceptible to manipulation. This is the same standard that the Commission uses when reviewing products for approval. DCMs must provide a written explanation and analysis to this effect, among many other things, in their certification. And unless the Commission finds that a new product would violate the CEA or Commission regulations, the DCM may list the new product no sooner than one full business day following the self-certification. And as a matter of practice, exchanges bring the vast majority of new products to market through the self-certification process.
And that's what the CME and CFE went through, right?
Right. So although it provides for a one full business day self-certification process, CME and CFE actually provided us with advanced draft contract terms and conditions for their Bitcoin contracts. And this happens from time to time. If there's a unique product or feature, we will work and engage with the exchanges. So in this instance, we first engaged with CME back in mid-October and CFE back in late July. And we reviewed the exchanges' information. We engaged in many discussions with them and met with them several times and evaluated whether any aspects of the contracts raised questions regarding compliance with the Commission regulations and the Commodity Exchange Act.
Is the agency limited at all in its ability to require the DCMs to make changes to the contract?
Yes. So as I mentioned, unless the Commission finds that a new product would violate the Commodity Exchange Act or the Commission regulations, the DCM may list the new contract. And DCMs, as part of the Act and the regulations, DCMs may only list contracts that are not readily susceptible to manipulation, and they must also monitor the cash settlement process for such manipulations, disruptions, or distortions.
Okay, we'll come back to that point in just a little further down the road, but I want to get to Brian. I want to move from the exchanges of DCMs to the clearing organizations, or DCOs, yet another acronym. Brian, what role does your division, DCR, have in this process?
So, first off, CME is both an exchange and a DCO, so it will clear its own Bitcoin futures, whereas Options Clearing Corporation, another DCO, will clear the CFE futures. So unlike Amir's side, the DCOs did not have to make a formal submission to the Commission, to my division, with respect to clearing Bitcoin futures. Their rule books essentially covered the activity that they were proposing to do. Nonetheless, they came into the division weeks ago, and they provided us with information on how they intend to manage the associated risks, including how they'll set margin requirements for these futures. And margin requirements are a key risk tool that clearinghouses have. Division staff engaged in a number of discussions with the DCOs on these issues and asked for additional information from the DCOs with a particular focus on whether the proposed margin levels by the DCOs met CFTC requirements. And like Amir, we didn't have a rule filing, but like Amir, we were looking to see if the proposed clearing arrangements satisfied Commodity Exchange Act and CFTC requirements.
provide just a little bit of context on the margin, just because I think this is interesting. Typically, I think CME has, like a 5% margin on the S&P 500?
Yeah, it's in the single digits.
And then, so what is it for the new Bitcoin futures?
So they came in originally at 27%, but when they announced their launch, based on discussions with us, they had moved it to 35%. So it's significantly higher than the run-of-the-mill futures contracts that CME lists and clears. On the OCC side, they have been at around 40%, or proposing about 40% for their margin levels.
Well, clearly one of the areas of concern that came up was the price volatility and its potential impact on the clearing organizations. Was that addressed through this higher margin?
Yeah, this is the key issue. So DCOs account for volatility in a contract like Bitcoin through setting margin requirements for the product. And again, this is products both at CME and OCC that are significantly higher than the normal futures contract. DCR staff looked closely at the margin levels that were being proposed and compared them to margin levels required for other products that have somewhat similar volatility characteristics, like some energy contracts and VIX futures contracts. Particularly when CME agreed to adjust its margin upwards, DCR was satisfied that the margin would be sufficient for these futures at both DCOs. Of course, I want to emphasize, Andy, that this isn't a one-and-done process. DCR staff on an ongoing basis is going to continue to assess the margin levels for these futures and at both DCOs to make sure they continue to be adequate. And one other issue I wanted to highlight is the suggestion that we heard during the run-up to the self-certification that DCOs should create separate clearinghouses for Bitcoin futures,
right?
Guarantee funds within the clearinghouse. And for listeners that aren't aware, a guarantee fund is a pot of money funded by all the members of a DCO to help deal with the default of a member when the margin collected from the defaulting member is not sufficient to cover the losses on the member's positions. That's why we say that there's a mutualizing of risk at clearinghouses. Separate guarantee funds at DCOs are not unusual. For example, CME has a separate guarantee fund for interest rate swaps. In other words, the risks of interest rate swaps and the users of those swaps are separated from the risks of futures at CME. However, the CFTC does not have the authority to require DCOs to establish separate clearinghouses or guarantee funds to clear Bitcoin futures. Those decisions are left to individual DCOs acting through their established risk governance mechanisms. But based on feedback that DCR staff received from a number of market participants, we did not find widespread support for these Bitcoin futures to be cleared in a separate guarantee fund. Moreover, division staff, among other things, assessed the potential risks of default in these futures contracts at both clearinghouses. And based on an analysis of different stress scenarios, staff estimated that any potential impact would not be significant to the DCOs. However, DCR staff will continue to monitor potential risk factors closely and work with the DCOs to ensure that the health of the clearing system is maintained.
Well, that's great. Thank you for pointing that out. Matt, let me bring you in. I've been waiting here for a little bit. How was your group involved in the Bitcoin self-cert process?
Sure. Thanks, Andy. And I'd say at the outset that really the Division of Market Oversight and the Division of Clearing and Risk really did the lion's share of the work and the analysis that led to last week. But from the DSIO perspective, we've really tried to do three things. One, we've evaluated the proposals and tried to predict what the potential impact from a market structure standpoint might be for these FCMs. In other words, we want to make sure that we can take what could be a relatively volatile product, particularly at the cash market level, and make sure that when the futures contracts are traded, that the future commission merchants are resilient and have sufficient capital on hand to withstand any shocks. besides that, we work very closely with the NFA regarding oversight, looking at what data they may have or may need, the information that we at the Commission might have. You may have seen the NFA put out last Friday morning an investor advisory telling people who might trade the Bitcoin futures contract to really do their homework, do their diligence, right, and make sure they're comfortable with what they're getting into. And then, of course, we've looked really closely at investor protection issues, sales practices, adequate disclosure. We want to make sure that people or institutions that transact in these markets are fully aware of the risks they may be taking.
Well, to that end, you brought up the National Futures Association. What do those guys do to monitor these new contracts, and how does that dovetail into the CFTC's kind of zeitgeist or mission here?
Sure. So the NFA is a member-driven organization. It's a self-regulatory organization, which means it works closely with the CFTC. And so they monitor their members. They've issued this investor advisory to remind people to do diligence before they transact. But they also look at the FCMs who are their members. They look at introducing brokers. They look at commodity trading advisors. They look at commodity pools and commodity pool operators. So in a lot of instances, they can be sort of the first line of defense, whether that's through an already existing reporting obligation or potentially requiring members to report in the future on an ongoing basis when they start to transact in these new contracts. And so, for example, we might see in the future new notice filings required when a registrant decides they want to either transact or help someone else transact in a Bitcoin futures contract. They may need to alert the NFA of that decision or of that activity, which helps us to conduct appropriate policing and oversight.
Well, that sounds like a pretty important role, so thanks for pointing that out. Hey, Amir, Terra Exchange and LedgerX have been registered by the CFTC as a swap execution facilities, or CEFs. Was that process the same, or was that different from the Bitcoin futures self-cert process?
Yeah, the process for CEFs, like DCMs, is the same. They also have the option to self-certify a new contract or submit it for commission approval. So they're subject to the same regulations as DCMs.
Okay. And Brian, what about on the clearing side?
So LedgerX needed to establish a new clearinghouse to clear its Bitcoin products. So this required an extensive multi-month DSIO registration process where we really lifted up the hood and made sure everything was operating the way it was supposed to. One key difference is that LedgerX's Bitcoin options are fully collateralized. In other words, the writer of the options posts at the clearinghouse what it can lose during the life of the options contract. So the clearing of the LedgerX products doesn't raise the same type of risk management issues as Bitcoin futures at CME and OCC. So the registration process is really focused on operational risks as opposed to the kind of credit risks that margining deals with at places like CME and OCC. And then on the Terra Exchange side, their offering is a bilateral contract. In other words, it's not submitted to clearing, so it just didn't raise clearing issues in my division.
Okay. Well, Daniel, let me circle back to you and get back to the structure of virtual currencies, because I think that's kind of helpful since this is the tricky area of this. But Chairman Giancarlo stated that Bitcoin, a virtual currency, is a commodity unlike any that the Commission has dealt with in the past. Now, others may say, some would compare it to another currency out there or even an index or gold. What makes the underlying commodity here, Bitcoin, unique from that standpoint?
Yeah, I think there are a few key distinctions or characteristics. The first I would note is that Bitcoin is completely virtual and it has no physical representation. So you're essentially representing value and a unit of account with letters and numbers that are published in code. Secondly, there's no central government or party backing a virtual currency. A third point is that the virtual currency and its network have rules that are established by a software protocol which can be modified by coders, and questions remain with respect to governance and accountability regarding potential changes. More specifically, all it takes for there to be a change to the software that powers the Bitcoin network is for a critical mass of network miners or mining pools to agree to adopt the proposed changes. And finally, ownership and possession of virtual currencies includes some very unique operational and cybersecurity risks, including the fact that if your private key is stolen or lost, you could have limited or no recourse in recovering lost funds or assets. So I think that these and other characteristics all combine to drive home the point the chairman has made, and that is that Bitcoin is a commodity unlike any the Commission has dealt with in the past.
Yeah, I think that's a great point. You need a really good, secure hard drive. Otherwise, you can lose all of your Bitcoin.
There have been stories of that, Andy, and folks trying to find those computers. So that's absolutely true.
I can imagine. Amir, generally, because I want to get back to what DMO does and surveilling this, generally, does the CFTC oversee the spot or cash market exchanges like oil and gold? Because that's kind of a key component of the way things work now. I'm just wondering how that would work for Bitcoin.
Right. So generally the CFTC has limited authority over the cash markets except for fraud and manipulation. The CFTC's primary oversight, as you know, is the derivatives market subject to its jurisdiction. But given some of the concerns that Dan just raised and the chairman has raised that Bitcoin is unique, we did work collaboratively with CME and CFE to increase the surveillance for these contracts. For example, we worked with them to strengthen the settlement process and the surveillance around this settlement process, including having information sharing agreements so they can get data regarding the underlying cash markets making up the settlement price. We also agreed that the CFTC staff will be engaging in regular discussions with DCM's staffs on surveillance issues around these products. So putting in place some of these measures, among other measures, we really wanted to enhance the surveillance around these products given the unique nature of Bitcoin and the underlying cash market.
Yeah, it sounds like it. I love that word unique. We keep using it when we describe Bitcoin because it truly reflects what's going on here. But Matt and Brian, let me kind of toss this out to both of you, and you can answer whatever you want. But what are the challenges here for your groups when it comes to Bitcoin or really any virtual currency? And why don't we start with you, Matt?
So yeah, thanks. I'd say that, and it's not necessarily even about it being Bitcoin or a new virtual currency, but it's a new contract. And so while we spent a lot of time talking about kind of the regulatory issues, it's also a serious market issue. And so I'd say one of the challenges that we face is just simply keeping up with the market and the market developments and staying abreast of sort of market structure implications, because we're all doing this for the first time, and as the chairman said, it's a commodity unlike anything we've dealt with in the past. So, from our side, I think just staying informed and staying ahead of the curve is a hard part.
Brian, you want to follow up on that?
Sure. I mean, I guess I would bring it back to volatility. I mean, the volatility is just really extraordinary in Bitcoin and other virtual currencies, and that makes it a key challenge on an ongoing basis. So division staff is going to be closely monitoring the clearing of these futures, as we do for all contracts cleared by clearinghouses subject to our oversight. And to facilitate these efforts, we receive on a daily basis just tons of information from our clearinghouses. And our risk surveillance team, which is based in Chicago, will be reviewing Bitcoin futures positions both at the trader and firm level, stress testing those positions also at the trader and firm level, monitoring the daily mark-to-market, including the size of variation margin payments, and how they compare to those margin levels I was talking about earlier in the podcast, and also comparing a clearinghouse's stress losses, which is hypothetical situations that lead to very large losses to the financial resources that the clearinghouses maintain, to make sure that the clearinghouse would have sufficient resources in the event of a default of a clearing member. In other words, we intend to stay on top of Bitcoin futures from a risk perspective going forward.
All right, Amir, Matt, Daniel, and Brian, thanks for coming on the show today. This has been really helpful.
Thanks, Andy.
Thanks for having us.
You bet. All right, that's a wrap for CFTC Talks this week. Remember, if you want to hear more podcasts, you can go on our website at cftc.gov and click on the podcast button, or you can find us on iTunes by searching for CFTC Talks on your podcast app. We'll be back next week with another guest or guests on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening.
But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guest. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.